Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, the Bank of Canada is walking a fine line on interest rates, and innovation in healthcare might help cure a sick system, plus helping Canadian youth do better. That's all ahead. First, for the week that was in business, it's time for the briefs. The Bank of Canada held steady on interest rates this week at 2.75%. With the economy doing slightly better than expected and inflation running a little stronger, there was expectation the bank would pause in its rate reductions, though most economists think that it will continue to lower rates later this summer. Macklem said the bank is watching the economy closely as it reacts to U.S. tariffs.
The longer these tariffs go on, the longer this uncertainty goes on, the more it's going to weigh on the Canadian economy, the more that is going to put downward pressure on inflation, and we will be watching that very carefully.
The whole world will see slower growth thanks to the U.S. trade war. The OECD is lowering its growth forecast to 2.9% this year and next, down from 3.3% last year. It's a reduction from its view in March, and it could deteriorate even more if the U.S. continues to impose tariffs on other nations, even as inflation edges higher. The Prime Minister met with provincial premiers this week to talk about the major projects that will be put on the agenda first. The group presented a united front and a list of criteria that would define a project as one of national interest. While the meeting ended without a specific list of targets, that could come as soon as this summer. Tariffs on Canadian steel and aluminum rose to 50% this week, a doubling that came after the U.S. president attended a rally in Pennsylvania where he made the promise. Trump and others are concerned about the presence of cheap foreign steel finding its way into Canada and then the U.S. Wildfires continued this week in Manitoba and Saskatchewan, forcing thousands of evacuations and affecting air quality across those provinces and the U.S. Midwest. Manitoba community of Flin Flon evacuated its 5,000 residents, with a total of almost 17,000 in the province displaced, along with about 8,000 in Saskatchewan and counting. And those are your business briefs. Well, the Bank of Canada may have made a call on interest rates this week, but the market is making its own call on rates that might affect the debt most of us pay. Penelope Graham is Director of Content at RateHub. Thanks for being with us.
Hi, my pleasure.
So let's start with the Bank of Canada and the fact that it held. I think we were getting pretty close to consensus that that might be what they do. What's your expectation for where we go? Are you still thinking that we see rates come down further this year?
So markets largely expected that we would hold today for the second consecutive time. They had baked in about a 75% likelihood that they would. But looking forward, and we really see this reflected in the language used by the bank in the press release with their announcement today, that they have to move forward cautiously. And there was a lot for them to mull over when determining the outcome of this announcement. Of course, inflation coming in April with that core measure creeping up, GDP also coming in stronger than expected, but highly expected to cool off in the coming months in 2025. So there's a lot of variables that the bank needs to take into account. And overall, it decided today it would keep its powder dry, so to speak, and hold off on adding that stimulus until we see more signs of economic stress. However, it is anticipated that those will emerge, and we'll likely see possibly another 50 basis points of stimulus when that does occur.
Of course, one of the things that's notable in the world is the degree of uncertainty is affecting bond markets. And at the end of the day, our mortgages and other debt is priced off of those market rates. They are definitely affected by what the bank does, but there can be a bit of a disconnect. Are we worried that mortgages, for instance, won't come down as much as they might have without this uncertainty in the world?
So fixed mortgage rates, which are based off of bond yields, have been largely in a holding pattern since mid-April. Of course, we saw bond yields plummet back in the early days of April after those reciprocal tariff announcements. But then they started to rise unexpectedly and acting in a way that's not quite typical for the bond market. That U.S. Treasury yield, for example, it skyrocketed because investors were becoming wary of U.S.-backed debt and more entrenched expectations that inflation will rise due to tariffs. And of course, we're seeing that reflected in the Government of Canada 5-year yield, which largely underpins the pricing for fixed mortgage rates. So yields in Canada have been largely elevated since mid-April. And until we really see any change there, it's unlikely we're going to see further discounting for fixed mortgage rates in the foreseeable future.
So good to have you, Penelope. Appreciate your time.
Yeah, my pleasure. Thank you.
Penelope Graham is Director of Content at ratehub.ca. Coming up, a close-up on Canada's healthcare system and some innovation that's making a difference. Stay with us.